unfortunately, we as Americans are pretty bad at saving. Actually, let me reword that. We're awful. And this video is not to beat up on anybody, but I want to explain what's going on and, more importantly, what we all can do so that we can become better savers. So let me share why I say we're so awful as savers. So this is data from the Bureau of Economic Analysis. It's a government entity, and they show the U.S. personal savings rate. And what I want to highlight here is, like in the 1960s, look at these savings rates. They're beautiful. 10, 12, 15%. I mean, for that period, that was about what you had to save in order to have a solid retirement. But then something happened in the late 70s, right? Inflation, obviously. And you can see the United States savings rate really took a nosedive, really until the great financial crisis in 2008. Then we went through a recession. People got a little worried, started saving some more money. You can see this big peak here. That's during COVID, where it went up to over 15%. I believe that's the highest it's ever been in U.S. history. And it's because, frankly, we couldn't spend our money on anything. But unfortunately, we're back down to the 4 to 4.5% range. So what's going on? There's a couple things. First, I'm going to beat up on all of us a little bit, and then I'm going to back out. You know, believe it or not, the average car payments in the United States, this is according to Experian, the average car payment was $734, and that's for a new car. And then for a used car, it was $525. And that's up significantly from before the recession. In fact, it's 17% according to the CNBC article. Here's why car payments are so high. We can talk about that, but a near record, almost 1 in 5 people have a car payment of $1,000. And CNBC would argue the reason that's going on is because prices of cars have gone up so much, right? They're basically supercomputers on 4 wheels now. But the price of cars have gone up so much, and interest rates are high. And this is from the CEO. This quote here is from Charles Chesborough, who's a senior economist, I should say, for Cox Automotive, which owns Auto Trader and Kelley Blue Book. And he says, the idea you're going to pay $700, $800 a month for the next 6 years, I mean, it just sounds crazy for a depreciating asset. So I agree with that. And part of the reason that these payments are so high is during COVID, the article goes on to say, many customers who bought vehicles at high prices in the middle of COVID are now underwater. In fact, it's a record number of people are trading in their cars and they're what's called underwater. So they owe more on the car than what the car is worth. And it's almost 1 in 4 people are trading in a car that's underwater and significantly underwater. It has a negative equity value of over $6,000. So let's keep going on the ways that maybe we don't spend money as well as we should. But I want to switch now and talk about our savings, the other side of it. 1 in 4 people in the United States have no emergency savings. And you can see this is what it is by generations. So Gen Zers, almost a little over 1 out of 4 have no retirement savings. Millennials, it's over 1 out of 3 millennials have no retirement savings. Gen Xers, these are people 44 to 59 years old. 31% have no emergency savings. And then baby boomers, 60 to 78, 16% have no savings. And you would expect that as people get older, we can save more money. And you can see it's 27% overall, according to this chart by Bank Rate Survey. No emergency savings, which is the data I showed above. Overall, if we look at all those generations, it's 27%. People that have some, but it would cover less than 3 months of living expenses is 29%. 3 to 5 months of living expenses is 16%. and enough to cover 6 months of living expenses, which really is what financial advisors would advise we all have, is at least 6 months of living expenses. And thankfully it's a little over 1 in 4, but that's still, really low, because we're putting ourselves in a bad situation if we don't have emergency savings. Fortunately, the Bankrate article goes on to say people are working hard on their finances, and almost 40%, 36% of U.S. adults are prioritizing both debt repayment and building an emergency fund. And unfortunately, it trickles into our retirement savings as well. According to Wall Street Journal, it's 80%, almost 80%, 78% of all Americans have less than $100,000 saved for their retirement, and almost half, it's like 49.5%, have $0 saved in retirement accounts. So what's driving this, right? It's easy to be critical about this. It's easy to say, oh, we all need to save more money, and we do. But I want to show another chart, and this shows what the median household income is in the United States. And this is by the Federal Reserve. And you can see here from the 1980s, we're at about $57,000. Then we peaked out at a little over $78,000 median household income. So if there's 2 adults living in the house, this would be the income of both of those people, median household income. But then at the start in 2019, it started to go down. So let's zoom in. And the median household income went from over $78,000 on an inflation-adjusted basis to about, 70, a little less than 75, a little more than $74,000. So that's a decrease of $4,000. That's a big decrease. Let's say that's a family of 4, and let's say their take-home pay is $60,000, right? An extra $4,000, that's a lot. That's 1/15, so it's 6 or 7% of their take-home pay. And obviously this is causing a challenge for all of us, and it's making it that much harder for all of us to save. So unfortunately, the American worker has not kept up most recently with inflation, and that's made things tighter and more difficult. And the economy's been quote unquote doing well for a while. The stock market's at an all-time high. What happens if there's a recession? What do we do then, particularly if people have no money saved, no emergency savings? And this is not just the situation with household income the way I'm showing it here, but even half of all U.S. households that are making over $100,000 a year aren't saving a dime. So we have a crisis, and the crisis, it's a savings crisis. So what can we do? Unfortunately, we have to change our habits. We have to change the way we're doing things. If we keep doing what we've always done, we'll always get those results. And for many people, the least sacrificial way to cut back on our spending is with our car. If you have a car payment that's $1,000 a month or more, think about when it comes time to buy your next car. Could you buy a used car? Could you buy a car that's 3 years old, 4 years old, 5 years old? It's still nice. It's been well maintained, but you have a car payment that's $400 or $500. That would be an extra $600 or $700 a month that you would save. And, that's an extra $7,000, $8,000 a year that we can start putting away. And really the challenge, one of the issues is in the United States, it's so hard to save that first $100,000. But once we save that first $100,000, then things can start working in our favor. So if you like this video, I think you'll also like this video where I talk about, we're saving this money for retirement. So what is the right age to retire? And the videos, why waiting to 65 to retire might be a big mistake. I'll see you in it. Bye-bye.